Rubin with our Real Tiffany here. Thank you so much for being with me today, Tiffany.
Thanks for having me.
You are so welcome. We have some great information to compare, what it is, so much to talk about. So let's dig right in. What is your FICO score?
So your FICO score is designed by your Isaac Corporation. It's an algorithm that determines a consumer's risk to a creditor. So TransUnion, Experian, and Equifax will be furnishers of data, which are payment data, but then FICO actually grades it and applies their algorithm to give you as an indicator of your ability to repay what you owe.
And why is it so important?
It's absolutely critical because when you go to purchase anything, whether it be a car, you need to know what is the likelihood that you're going to actually repay the debt.
Makes sense.
Absolutely. So it seems simple. However, the calculations or the factors that go into calculating that FICO score can be pretty difficult to understand. Unfortunately, we're not often educated on what those are before we actually use our credit cards. So it's important that we do research and understand how the FICO score is calculated.
So can you give me an idea of how your FICO score can impact you? What kind of a difference a consumer can expect to pay in increased interest rates and so on if they have a lower FICO score?
Absolutely. So honestly,
it's
it's okay. It's okay. I think the basic premise is that if you have, a negative FICO score or low FICO score or credit challenges, typically that's defined as anything under 680. So the FICO score goes from 350 to 850. It is possible to not even have a FICO score at all, which is almost worse than having a bad credit score, a FICO score.
I ran into that recently with a client where they didn't have any negatives, but they just didn't have any credit. And so they were in the process of building credit, period.
Absolutely, and it's important. It's imperative that you actually have credit. So it can often be the chicken or the egg game in terms of, well, how do I get it if nobody will approve me? And we can talk about how to do that later. But essentially, to your initial question, if you have negative credit or low credit scores, obviously you can either be denied completely for the purchase that you're trying to obtain, or you're just going to have to pay hundreds of thousands in terms of, like, for example, a mortgage, of bigger payments and longer periods. Our FICOs tell you, though, that the FICO score slides really generously from the low ranges into the high sixes and then slows down. And it's really hard to go from a 750 to an 850.
Interesting.
Yeah.
Okay. So, let's dig into some of this. When we're talking about payments and managing your credit, we've done a video on this that will actually live permanently, but let's talk about this right now live too. What is the impact of late payments on your credit? I think a lot of consumers are not aware at how drastically a late payment can affect their credit.
Absolutely, they're not, and we're not taught this. So the minute you're late, there's no big deal. 5 days late, you obviously can receive a penalty from the creditor. But once you hit 30 days of being late and not making a payment, you will absolutely be reported to all 3 credit bureaus as having a late payment. And that late payment normally drops a FICO score anywhere from 60 to 80 points the month that it's actually reported on your FICO score.
Okay, and then that 60 to 80 could be taking you from an A plus to a B in 30 days.
Absolutely.
It's really important. Now, a lot of people will, I'll just wait till I get paid on Saturday and you'll be late. But what you really would want to do instead would be to, if I'm understanding, is make that minimum payment, get them something, and then pay that full on that Saturday.
Absolutely.
Okay.
Absolutely. And then keep in mind that there is no difference in FICO score penalty from, for example, a mortgage late. What more important, for example, and it may be in another area of life, but FICO score will penalize equally severely any type of 30-day late.
So it doesn't matter if it's a $50 payment or a $3,000 payment, they are going to weigh it exactly the same.
Exactly.
This is good information. So when you're talking about credit repair, which is what you do in your area of expertise, are there any things that consumers can do on their own? And if so, what are the pitfalls that they might encounter? What kind of things could they err and make mistakes on?
Absolutely. So like I said earlier, honestly, anything in life can be done on your own. I mean, you can do research and fix your own credit, absolutely. The key to doing that, if you really want to know how to do it, is to go online, research directly from Fair Isaac Corporation, so that you're getting real, accurate information in terms of what. And by doing your own credit repair, I don't ever recommend it. We've seen nightmare stories happen. But some of those may be, for example, paying off a car loan or paying off an installment loan and not realizing that you're losing a positive trade line that was essentially building your FICO score for the last 5 years.
Okay, so let's pause on that because we said a few really important things in there. An installment loan. What's an installment loan, just for people who may not understand the difference
Absolutely.
in one type of credit to another?
So a revolving line of credit would be a credit card.
Okay.
Some usage in comparison to the available credit limit that you actually have available to you.
Okay.
Those build FICO scores much quicker, and they remain open when the card is paid off unless you close it.
Okay.
An installment loan literally closes the very last payment that you make. So if you, for example, have an installment loan like a vehicle loan, and you make that final payment, you lose all the positive payment history that was building on that account.
Okay, so that 6 years of paying that car payment, which would be a great history to have on your credit.
Correct.
If you pay that off 6 months early, yay you!
Yes.
Not so much, because now you're losing that 6 years.
And then the other thing we see with do-it-yourselfers is that they go in and they try to negotiate their collections on their own, and they get them paid, but they didn't realize that some of the collection accounts weren't really negatively impacting them as much as they thought. And so when they brought
In other words, it's already done its damage.
It's already
because
done it.
marked as a late. It's already a mark on the credit.
Correct. Well,
Okay.
and it continues to be a negative, I guess, factor.
Okay.
However, once it reaches a certain age, what we call the date of last activity,
Okay.
it's no longer impacting as much as it would if it were recent, which would be within the first 4 years. And if you bring it current, you make a payment on it, you've actually reactivated the date of last activity on the account, and it is now going to drop your FICO score even though you brought it current. So it
Sounds
super,
so counterintuitive.
Yes,
and
you
that's
don't-
why businesses like yours exist, because much of what you're dealing with when you're repairing your credit may not be what seems to make sense on a logical. It needs someone who is an expert to navigate you through
Absolutely.
and make sure in trying to improve your credit, you're not actually hurting your credit.
Absolutely. And then the third thing that we see with do-it-yourselfers a lot of times is that they'll go online and they'll find form letters. And they'll find form letters to send to the credit bureaus disputing derogatory payment history. What they don't realize is those form letters have been there often since the 1980s. And the credit bureaus see those same form letters over and over and over, and they consider it a frivolous attempt to be disputed or to dispute an item. So when you're disputing and you're sending a letter to the credit bureaus, it needs to be tailored to the date of the last activity of the account, the amount that you owe. You need to be placing the burden of proof onto the credit bureaus themselves to verify data, not to match data. So when you're disputing, it needs to be done very technically so that you can actually have it deleted permanently and efficiently.
Oh, this is interesting. Again, so much that is counterintuitive when you're talking about cleaning up that credit. What would be like the most important first step for someone who has a score in like the low 600 B plus A credit?
Yeah, that's a good question. So the very first thing you want to do is sign up for some sort of monitoring program. A monitoring program will assist you as a consumer in learning how your score behaves when you make consumer decisions, when you pay certain things off, through your collection accounts, and you're trying to figure out what will help me, what's going to help me, what's going to hurt me. So obviously monitoring is essential. You got to have a credit report that's up to date, that is what we call a FICO score, provides a FICO score, not a FACO score. There's lots of different versions of that credit, very inaccurate. So that's the very first thing.
Okay.
And then the second thing is you have to understand how the algorithms are calculated. What is the most important part of the FICO score? Well, that's your payment history. So having negative items removed will make the biggest improvement in your FICO score. But just under that is managing your utilization ratios, which is just a fancy word that we use in the credit industry to talk about how much you owe on your revolving lines of credit, like your credit cards, and what can you increase your FICO score and lower your credit risk.
Okay, so dig into that. There was what did you, the credit
Utilization.
utilization.
Yes.
Yes, let's dig into that a little bit deeper.
Okay, so the FICO score gives heavy credit to how much you owe in relationship to how much is available to you. So a credit line, for example, that has a limit of $1,000, and let's say a consumer is charged 500, which is half. FICO considers that a maxed out credit line.
Even though they've only used half of the credit.
Correct. So
Okay.
they've been penalized severely for that usage. Once you pay down your credit card, that particular credit line, to 25 to 35% of your available credit limit, you're now in a positive revolving status. And that's going to actually build your FICO score pretty aggressively.
So if you're using a lot of one particular account, say you have 5 credit cards,
Yes.
which might be a lot, but if you have 5 of them and you're using one card for all of your expenses
Yes.
and getting that up to 90% of its balance every month and then paying it right back down again, they don't like that.
No.
You'd be better using 1,000
Multiple.
on each of those cards. Again, counterintuitive.
But remember who that's in favor of: the credit card companies. So the credit card companies can charge interest, and they want to have consumers in debt. So the FICO score is designed very much in favor of the credit card companies to win. So therefore, if we had one card paid, and maxed out, then the other credit card companies would suffer. So they want to see that we're just in debt. So again, there's a way to blend what makes good FICO sense with what makes good financial sense, and there is a way to do both.
Okay. Now, how does a card like, say, an American Express, where they don't give you a limit, how does that affect your credit score in terms
It's
of?
the same. It's okay. And by the time you qualify for that type of card, you typically have good credit.
Okay.
Some of the rules a little bit when you're at fourth. The key to those kinds of cards is just managing it, never being late. I don't ever recommend those cards for people with credit challenges anyways. I would always recommend that you build your credit, use it effectively and responsibly, and keep those utilization ratios moving forward, because you're going to see organic bumps in your FICO score much quicker from different types of cards than that. But I just want to make one more point on that. You don't have to carry 25 to 35%. So if you're at 10%, that's even better. So a lot of times people will hear that advice and think, oh, I need to have a 25 to 35% utilization balance in order to have good FICO scores, and that's not true.
I remember when I was taught with my credit, and I was actually very fortunate that my grandfather at a young age. So my first credit card was a department store card that I got at a young age, and he was like, use it a little bit and pay it off every single month. And so that was kind of my my initiation into building credit, and probably why I was able to purchase my first property when I was 21.
Absolutely.
Because I had been told at a young age and then followed those steps. So when you're managing and you have good credit, is obviously going to be better than carrying that balance.
It is if you've got a decent FICO score. I will tell you though, carrying a zero balance is not going to build your FICO score.
Right.
So if you have it, you have the credit cards, and let's say you are the type of person that pays it off every month, that's great. But when you're first trying to go from like a 500, for example, to a 680, you're going to see faster increases by carrying a small balance, making maybe 1 or 2 on-time payments, and then paying it off in full maybe the third month. And that, by the way,
demonstrating that you can have debt,
yes,
and then pay it off.
And that, by the way, has changed since when you and I were younger. So that's a new,
interesting.
yeah. So that's different. And again, that's why you want to keep up on your information and make sure that you have the most updated information.
There is a lot to keep up
Yes,
on. That is
yes.
for sure.
Yeah.
So, so what should someone who doesn't have any credit at all? What would their first steps be? We talked about it a little bit, but what would your 18-year-old daughter is coming to you and saying, Mom, which of course you don't have an 18-year-old daughter, but
Thank goodness.
but what would you tell your niece or your nephew that's coming into credit age about getting started with their credit history?
Well, a lot of times what we'll tell the parents of a young person is, as an authorized user on one of your cards, but don't tell them. Do not give it to them. Do not let them know that you've done it. And actually, it's good to start around 16, around the age of 16 or 17, to add a minor to one of your cards. Now, keep in mind, though, it needs to be a long-standing account. It can't be something that's brand new, because it has to have some account seasoning. Okay? And you cannot have charged over 25 to 35%, or else you're going to be penalizing your, significant loved one. So again, have a low balance account. Once you add, for example, a family member to that card, they will automatically acquire the positive payment history that you've had maybe 10, 15 years of.
Oh, wow.
So that'll build a FICO score for them without them even knowing it. So that's my first and favorite option.
Okay.
But let's say you don't want to go that route, or maybe you don't have 25 to 35%. Maybe life events have happened and your cards are maxed out, and you're working on your own credit. Then the second thing that we recommend is secured credit lines.
Okay.
Secured credit lines are simply a basic concept of a prepaid phone card, for example. You would go down to a financial...
But not a prepaid phone
No.
card.
You would use the idea of that.
Right.
Go down to a bank, for example, and they'll give you a secured line of credit. It'll be a Visa, MasterCard type of credit line. And you're going to give yourself your own money. Basically going to apply, believe it or not, they're still going to make you apply.
Okay.
And you're going to give yourself $1,000. It could be $500, $250. And then what you do is you use it just like you would any sort of credit card, making small purchases, making on-time payment for 2 months, and then making a full payment in full.
Okay.
And that will establish your FICO score pretty substantially. Now, the danger in that is that if you get a secured line that's only a $250 credit line, it is very quick to go over 25 to 35% usage.
Mm-hmm.
So you gotta be careful. So nowadays, a tank of gas and groceries can put someone over, several $100s.
Yes.
So gotta be careful with that. But
So it's really important that they use that building card
Yes.
and keep in mind those ratios again.
Absolutely.
So it has to be under 50% used.
correct.
But you still want to use it.
Absolutely.
So it's that you are walking a tightrope. This is truly an exercise in building credit. It seems like you're going to make mistakes quickly and easily.
And especially if, for example, I see a lot of couples do this where they each and same secured line, 2 cards on the same account. Well, if you don't communicate that you're going to Target and I didn't tell you I'm getting gas and the card's only a $500 limit, it's easy for there to be an issue.
I can't even walk into Costco.
No, me either. Nope. Off limits with that.
Every time I'm in the store, I'm like, they should not let me in the door.
Yeah.
Not even like I should not be allowed to walk through the doors of Costco.
Well, they're probably going to valet your car. They love you so much.
Yeah, they would. They would. My home, in the door home after
That's funny.
I've been there. Gosh, good stuff. Okay, so let's talk about we've covered, like getting started with your credit. We've talked about. Did we talk about some of the pitfalls that people make?
We did.
We did. Because there was some stuff that I know that is so counterintuitive. What about, that was what I wanted to talk about. When you are looking to repair your credit, who and where and how?
Yeah.
Because this is an industry, I'm going to say, that is kind of fraught with shysters and people preying
Unfortunately, yeah.
on those that are vulnerable and taking advantage. So how can we steer the consumer who's looking to do the right thing, looking to repair their credit, maybe they've made some poor choices
Yes.
or had some life events happen to them, how do they find the right people to work with to get their credit in good shape?
So important. In any financial industry actually you got to do your due diligence for sure. I mean, I've seen it in insurance, we've seen it in financial services. So our industry, although it's important, it's in every industry nowadays. So the biggest thing you want to do is do your due diligence in the state that you're in and find out what is the requirement of a credit repair company in my state. We are in California. So if, for example, you were to be seeking out a credit repair company in California, you need to make sure that they're registered with the Department of Justice.
Okay.
You can go on the website and find out who is. And it's not a one-time fits-all thing. It's every single year the DOJ requires that every credit repair company go through their scrutiny, basically, and be vetted. And basically, they'll go through an audit to make sure, is the program legal and ethical? How are they billing their consumers? What type of marketing materials are they using? Are they over-promising and underperforming? Things like that. So number one, are they bonded? Are they registered with the Department of Justice? One of the biggest ways to tell if you're working with someone that's legitimate is, do they have an office? Are they local? Is it a 1-800 number? Can I touch it, feel it, see it, and go in and actually speak to a human and have somebody look through my credit report and really give me a free or complimentary roadmap, because it's not a one-size-fits-all thing. Every single person is different.
Mm-hmm.
Everybody's different.
Mm-hmm.
So you want to make sure you have face-to-face contact. The other thing that you want to make sure is, are they charging up front? Did they tell me it's going to cost $4,500 and I have to pay it up front before they start working on my credit repair?
That's a no-no in the...
Big deal. That's a big deal. The DOJ says absolutely not. It's okay to charge an enrollment fee. An enrollment fee, you guys, is just simply a fee to cover the education that a consumer is going to be getting. If they're in a really good credit repair program, they'll be getting ongoing coaching, sometimes 5, 6, 7 times a month. But they're also paying for their campaigns, or their credit repair campaigns, to be completely tailored to their individualized credit, what we call fingerprint. So in our case, that would be $199 to enroll, and in the state of California, we could charge up to $500.
Pinpoint on that. Your maximum in the state of California, maximum enrollment fee if someone is looking to repair their credit should be no more than $500.
Absolutely.
If someone asks you to pay more than that, they are in violation of the California state rules.
Absolutely. And then the cost of the repair itself, which would be the letters that are sent out, the negotiations of collection accounts, all of that has to be billed in arrears. And that just simply means that after the consumers receive the service and they're in receipt of the results of their product that they're paying for, then they pay a monthly fee. In our case, that would be $79 a month. So the other thing that you have to look at is, how long are they estimating that the credit repair is going to take? A good credit repair program should not be a year long. It shouldn't be 2 years long. In our case, I've been doing this for 13 years. We have a full team of people that have been doing this, six full-time people in our office. I will tell you, the majority of our people are done within 3 to 6 months, and 6 months would be like major trauma. That would be tax liens, bankruptcies, foreclosures, divorce drama. I mean, it would be a pretty severe situation that someone would be in 6 months.
So we're talking about a total of investment, if they're looking at, with your company, for example, a $200 enrollment fee, and then $79 a month for 3 to 6 months.
Correct, right. So the average consumer pays about $500.
Okay, total to get everything as clean as possible.
Absolutely.
Which, by the way, if you're looking at just in a home, I would say if you could bump someone from $680 to $720,
absolutely,
you'd probably save them that in 2 months or 3 months of their mortgage payment interest.
Absolutely. Yeah. It's a no-brainer for sure. But again, to your question, make sure it's you're working with a company that's legal and ethical, and that they're bonded. They need to be bonded.
And just for conversation purposes, incidentally, I don't believe there's anyone else in our immediate geographic region other than your company, Dedicated Credit Repair, who is legal, bonded, DOJ certified.
Absolutely.
All of those
there is
things.
not. No.
So if you are in Temecula and area with Dedicated Credit Repair, and they are the only people in this particular region that are authorized to do that kind of work.
Absolutely. And then the other thing too.
Infomercial.
The owner of the company show you their credit report. I think it's imperative. I've seen people and there's a couple locals that do credit repair illegally, locally. I won't say anybody, but let me see your credit report. What does it look like?
You should have
incredible FICO
walk
scores.
The walk, talk the talk.
Yes.
Yeah, that is a great inside tip. And is that something that your company has?
Absolutely.
Have you ever had? I have to ask. Have you ever had anyone ask you for it?
Hundreds of times, and guys, I'm carrying it right now in my binder just to make sure everybody sees it. So
if it wasn't all the way over there,
I
would totally grab.
Yeah, it's important. It'd be like anything in life. You got to make sure that the person is walking the walk, talking the talk, and knows what they're talking about. And frankly, the third in a previous interview with someone that I like to do is walk in the office and have them show you 15, picking a number, 15 success stories from this month. Anyone can have things removed a year ago, 4 years ago, 5 years ago. A foreclosure removed one time 10 years ago. Show me foreclosures that were removed on real credit reports from this month.
Ooh, good question.
Yes. Show me before and afters. I want to see before and afters of real scenarios so that I know going into this that this program works. And I think that's fair to ask.
It is a really, really great tip. I love that question. There was another question that came to mind while we were covering that, and of course now with brains being what they are, and because we're live, I'm like, what was that other thing?
We'll think about it when we're done.
Oh yeah, exactly. So when we are talking about, the brain's processing, do you see, and steam coming out of the windows here. What are some of the craziest things you've had to do in your work? Let's get a little personal.
Oh gosh, there's never an identical day. Like I said, I've been doing this for 13 magical years, and there is not a day that's ever the same. It's kind of crazy, but I will say, I think six.
Without violating any confidentiality.
Yeah, no, we had a couple come in. It's actually funny. A wife, or I guess ex-wife, with her ex-husband and her current boyfriend, and they were all living in the same home.
Okay.
And I mean, imagine that. So they came in with all their credit reports, and the dynamic in the office was extremely bizarre. But at the end of the day, their goal was the same: is they wanted even the ex-husband wanted to move out, but his credit was bad. So the boyfriend was going to pay for the ex-husband's credit repair, and they all wanted to be in the room at the same time to come up with a strategy to basically help the man get a better FICO score so he could move.
Oh my.
I about died, but it works. I mean, we got them all on the same page, and he's
And
one
out
mine.
of each other's houses.
Yes.
That
I
is
mean,
something that
just
you would
stuff
not
like
think
that.
about. Okay. Yeah.
Crazy stuff. It happens. I mean, you can imagine.
What's the most unique item you've had removed from the credit score?
People think that there's a difference between, for example, a bankruptcy or foreclosure. Like, how could you get those removed? Well, again, everything that's being reported on your credit report falls under the guidelines of the Fair Credit Reporting Act. So we have had investors, from 2008, 2007, 2008, 2009, that lost their shorts, frankly, in the in the industry. So, and what we did was, I've got, again, before and after credit reports to show. Some people having 8 or 9 foreclosures removed, bankruptcies removed, paid tax liens, you name it, removed from a credit report.
I don't know that we did talk about that today, but as an interesting discussion point, if we haven't, because we've talked about so many things, but when you talk about different credit, you do think that extensive payment and that high payment is going to impact your credit score more or less.
Yeah. You would think so. Again, they're counterintuitive. But you get more FICO score points by paying off something that's a $50 account than something that's a $4,000 account.
Yet, if you close an account that you've had for a long time after you've paid it off, that can also be a big no-no, right?
Absolutely. Yeah, you don't want to close anything. So I know this is, again, Susie Orman, Dave Ramsey, that's the first thing they tell you.
Experts.
Absolutely. And they're right. They're right about financial freedom. They're right about being debt-free. They're right about coaching people to live in a debt-free manner. However, like I said, we live in Southern California. Unless you've saved $500,000 in a mattress somewhere, and even then we can't in California because you got to source the money.
You got to source no mattress money
can't
at
do
all.
You can't do it. So we need our FICO scores.
We do.
Yeah. So I'm all in favor of Dave Ramsey. I love him to death. I actually use his system personally, but I blend it with what I know about credit.
So what are some other big mistakes that people make and pitfalls that people make with their credit?
Well, there's a lot. Besides just paying off and closing accounts, settling collections incorrectly, collection accounts that is, one of the things that people don't really talk about are credit inquiries. Credit inquiries is just defined as you running credit. So, standing in line at Kohl's, for example, I'm not picking on Kohl's, but they're notorious for it, especially during the holidays.
Would you like to open an account?
And save 25% today. When you say yes, you're going to have your credit ran. And when they run your credit, you're going to lose sometimes 5 to 10 FICO score points per time. So again, that's a hard inquiry that stays. Now, keep it only 2 years.
Okay.
Everything else that's negative would stay for 7. So it's
now,
not.
What about when that company that you've been working with for, you've had that account and you've maintained it, and they want to increase your credit, and they say, oh, you may qualify for more.
Yes.
Do they run your credit again for that?
They do. However, that's a soft inquiry. So there's only 2 types of soft inquiries. You just mentioned one.
Okay.
One where you're currently a company that you currently do business with pulls your credit.
Okay.
And they do that to make sure that your credit risk is not changed.
You're still a good candidate for that credit that they have outstanding.
Or they want to increase your credit limit. So you're right. So that's a soft inquiry. The other soft inquiry is when you as a consumer are curious, and I recommend recommend that you be very curious about your credit often, and you go online to myfico.com, annualcreditreport.com, any of those consumer websites.
Is there one that you recommend over another?
100%. I would always recommend myfico.com.
Okay.
It's Fair Isaac Corporation's website. You're going to go right to the source and get all of your FICO scores, because you're going to have your auto FICO, your mortgage FICO, your installment FICO. There's lots of different FICO scores, but you're going to get the real deal.
Okay.
And so that is a soft inquiry.
Okay.
Any other inquiry, whether you're at a car dealership, which by the way, they're notorious for 15, 20 inquiries at a time from just one car shopping experience. So you want to make sure that you're coming in with your own report when you're looking for an auto, by the way, my tip of the day.
Good tip.
Bring it with you with today's date listed on it with your actual FICO score.
Because that won't have a hit.
Correct.
Because it's your own inquiry as a soft inquiry.
That's correct.
Big learning today. Soft inquiry versus a hard inquiry.
Absolutely.
So when you're applying for, or when you're shopping for that interest rate, whether it be home or auto, if you provide it to those lenders, they'll have the information they need.
Absolutely. Need to
They're
continuously
going to have to
run
run it hard at some point.
Correct.
If you're moving forward with the credit.
Correct.
But they're not going to have to do all those little soft things. You go to 6 different dealerships, that's 30 points.
Easily. And a lot of times people are misinformed, and they'll say, well, I thought I read somewhere that as long as you were shopping for a home or a car and there was a little flurry of inquiries, it was only to affect you once. And that was supposed to be how it was designed to be. And in theory, it should be that way. But in practice, what occurs is when you get different companies running your credit from different credit sources, which is what they do, then it's going to be individualized, and there are going to be individual penalties.
Okay. So important to have the information, take it with you to the dealerships, and then only originate that loan the one time.
Absolutely. Go to a credit union. Go to a credit union for your loan. Yeah.
Unless you're doing a lease and they don't do it, that's a whole different.
That's
a whole different discussion. But it is. That is a good point. And I also, to that point, I know that the last time we personally did a loan, and our loans are always lovely and complicated because of the nature of my business and my husband's. But we had to answer to every single ping that had been on the account over the period from when the loan originated to when we actually closed. They wanted a letter of explanation for each one, which wasn't a big deal. It was easy enough to do.
Right.
However, it was just another thing that we had to do in a series of, when you're already busy doing other things, you're like, really? But you guys, and that was in that exact instance, was 2 different lenders that had pinged 2 different reports, and they're like, we just need a letter saying that it was in regards to the same loan, but they want to know who is looking at your credit and why they are, because they want to make sure you're not trying to buy a boat while you are buying a house.
Correct. Absolutely.
Those are some.
Yeah.
Who knew? Guys, really, like, this is super important information and can cost you money if you misstep.
Yes.
Especially the one that I think blew me away the most today was that late payment versus on-time payment. Because you would think, oh, well, I'll just get it in a couple of days later and it won't be a big deal. But about 80 points quickly add up. You do that with 2 or 3 creditors and
and the consumers often think, okay, well, I brought it current, so it's no longer on my report. And that doesn't matter. Just because you brought it current, which is great, it doesn't remove the 30-day late. So it's still going to be there. It won't continuously hurt you every month, but it will remain on your credit for 7 years, and continues that 60-point deduction will remain there for 7 years.
So let's talk about someone, I'm sure you deal with a lot of people who have damaged credit that are trying to get into the range just to qualify for loans. But what about that fine tuning? What about those people who have the 680, 700 that are trying to just bump it back up? Maybe they've had 1 or 2 little hiccups. Bump it into that A+, because those A+ and A ratings are where you're really getting your best interest rate. So
absolutely.
What are some fine tuning tips that someone who's pretty good with their money can do to bump it up?
Well, in any situation, I always recommend that you have a credit checkup like you would any other type of checkup. Go speak to someone that knows how to create a financial roadmap from a credit perspective, not a financial only perspective, and have them evaluate your trade lines, have them look at your credit lines, and see which accounts could be paid down, which ones in which order. Do you have medical debts? Do you have medical collections? Are you co-signing or planning on co-signing for student loans for your kids in the next 5 to 6 years? You know, what is it that you're trying to accomplish? Because as your goals change, your strategies will change and your techniques will change. And so what was true 4 years ago, for example, isn't true now.
So it's not just as simple as pay everything off and keep a zero balance.
No, it's not. It's absolutely not. And so, and that's important. It's important to know. They look at diversification of credit. That's 10% important. They look at your inquiries.
So we've talked about those percentages. Let's like round that full picture out. 10% of your credit.
So when you look at the pie chart, it's a pie chart.
What slice of the pie goes to
Okay,
what?
so the biggest component is 35%. That's your payment history.
Okay.
That's your on-time payment history versus your late payments.
Okay.
So it's the largest component, but it's not 90% like most consumers think.
Okay.
So we're 35%.
35% payment history.
Yep, the second largest is 30% important, and that's your credit utilization ratios that we use that fancy word to show what your usage is in comparison to, and again, how many cards do you have? So not only do they want to see your usage low, but they want to make sure that you have at least 3 to 5 revolving lines of credit. Revolving, remember, is credit cards. Okay. So now we've got the 35% covered, the 30% covered. Then
so a single credit card could hurt you, but having 3 to 5,
you're
well
ideal.
managed, you're in good shape.
Correct. If you just have one, you're going to be missing 30% of your score because they consider you to have inadequate credit or thin credit.
And revolving.
Correct.
We're not talking about your auto payment or your mortgage payment. You're talking about the Kohl's or the
bank cards,
the Visa, MasterCard, American Express.
Correct.
Okay.
So 35% payment, 30% credit utilization.
So we're 65%.
Now the 15% section is your third most important. That's credit history.
Okay.
That's how long have you had the credit? Are they all brand new? Are you a newbie in the credit world? You know, are all your credit cards 15 years old, for example? That's fantastic. So they're looking at credit utilization and then your credit history. Then the next section would be 10%, which is your what we call credit, with basically credit inquiries. And that's really where they're looking at how many times are you running credit? What's your credit look like you said? Are you high risk? What's going on? Why are you shopping it for 20 things at the same time? Are you, losing your marbles and trying to fully decorate a home you don't own yet and buying furniture? So they're looking at that. And then the last and final component, which is the second 10% section, is your diversification of credit. And that really handles itself over time.
Okay, that's really, and also on that same point, even though it's completely not related to credit repair, I always like to throw it in when we're talking about furnishing your home and closing escrow and those kind of things. One of the biggest, silly, easiest preventable mistakes that people make when they are in that escrow process and closing is that they will take on an additional piece of credit right before a loan is closing and blow the deal. Almost anyone you talk to in business has a story of a deal that either fell apart or almost fell apart because someone went and bought that new car or bought a television. You don't want to take out any new credit at all if
or bought another car.
Or
all the time.
Yes, and you're about to buy a house. You want to wait till the escrow is closed and record it.
And
record it.
Don't change your job.
Yes, that was when I heard
your
recently
career.
someone who retired in the middle of the because they had met all their goals and they retired and they literally, it ended up coming together and they had a pension coming. But because it hit as a flag, it almost blew the whole deal. And they
no
were
life
lucky.
changes, nothing.
No,
leave it alone.
Yes, exactly. I'm like, just
don't do
meditate,
anything.
Zen, which doesn't affect your business, but you see
It
the
does,
stories.
though. It does, because you mentioned earlier, asked me earlier, what can a do-it-yourselfer do, or can they while they're in your program? I gotta tell you, some people are so excited that they're actually doing something about their credit. They've been waiting for years to actually get to start doing it, and so they get overzealous, and instead of trusting us, the experts, they get in the mix and start doing weird things that kind of damage what we've done, or the progress that we're doing. So again, lay low. Don't do anything. If you hire a professional and you've done your due diligence and you know that they know what they're doing, it's okay to keep a thumb on them and make sure that they're performing and doing what they're supposed to be doing, but don't get in the mix and start becoming a credit expert in the middle of nowhere.
Right, because as we were talking about earlier, if you close the wrong account
Yes.
or make a payment in an account, oh, well, wait, I'm doing really well, and then that one account is now suddenly popped back up to
Yes.
the top of the list, and it wasn't even on the radar before. There are so many pitfalls that
Yeah,
that you
absolutely.
can make inadvertently.
Absolutely. And one of the things that we see too is when people hear, oh, well, it's better to have, more cards with a balance than one card paid off or one card paid off, for example, they may open a new credit card in the middle of a credit repair program and then wonder why their scores drop 40, 50 points. Well, a new credit line will drop your score. So it has to be done strategically in the proper order.
There is so much to know. This has been so informative, and I've even learned some new information about managing your credit. I was 18 and you were 20, and like it is not necessarily a set fixed
No.
platform of rules.
No, absolutely not.
And also another good takeaway is when you are doing the loan shopping, you will talk to a lot of people who are in lending, who will say, oh, it doesn't matter if you just do, because you're shopping for a loan or because you're shopping for a car, it'll show with that false information
Correct.
that you were talking about earlier that it won't affect your credit rating, when in fact it will, as we learned today, by 5 or 10 points.
Yeah, absolutely. Yeah, and I always say my mortgage lender referral partners are my favorite, but they're a lot of times armed and dangerous because when they're talking to consumers and coaching them, they're giving underwriting guidelines, they're giving coaching based on what would be a loan underwriting approval, but they're not always considering that some advice could have a contrary or opposite reaction to the FICO score.
Yeah, they're a lending expert, they're not a credit repair expert.
Absolutely.
Gosh, this has been super valuable. Well, thank you
Thank you
so,
for having me.
so much for all of this good information. How can we find you?
So the best way to contact us is to go to our website, which is dcrusa.com, which is dedicated credit repair, dcrusa.com. You can go directly onto our website. You can schedule a free consult in our office website. All of our programs are described and priced right there for you. And then you can always call too, which is 951-246-7754.
Awesome. Well, thank you so much, Tiffany. If you know someone who would benefit from this information, please share this video with them. If you have a topic that you would like us to cover that we didn't, please be sure to ask us in the comments. We will happily schedule another live or do another video on that topic. And be sure to like and subscribe to the channel for more information on credit repair and home buying, home selling process. Thank you so much for watching, guys.
Thank
We're going
you.
to say goodbye.
Bye.